Married couples between the ages of 25 and 34 have 9 times the net worth of single people the same age. 9 times. And that gap was 4-1 back in 2010. In 1989, it was 3-1. So every single decade, the gap between married and single gets wider and wider. Okay? And before you assume this is a video about whether you should get married, it is not. This is a video about math. Specifically, it is about a type of math that operates the same way compound interest does, that most financial educators completely ignore, and that is quietly determining who builds wealth in this country and who does not. Because here is what the research actually shows. When you get married is not a lifestyle preference. It is a compounding financial decision. And most people are making it without knowing the math at all. Your financial advisor probably never brought it up. Your parents probably framed it as a personal or emotional question. And the apps and streaming services making money from your single lifestyle definitely are not going to say a word. So today we are going to show you the mechanism. 7 stacking financial advantages that turn a marriage certificate into something that functions remarkably like a compound interest engine. And then we are going to show you the math of timing, because it turns out that when you start that engine matters more than almost any other variable in the calculation. All right, so how does this actually work? Why do married couples have 9 times the net worth? Let's walk through the 7 mechanisms, because none of them individually is the whole answer. It is the stack that produces the number. Mechanism 1, shared fixed costs. A single person in the United States pays roughly $17,899 a year on housing alone. A married couple pays roughly $24,811 total, which is about $12,400 each. That is a difference of more than $5,000 per year per person just on housing. In a city like New York, the full singles tax across all fixed living costs runs over $20,000 per year extra. Across 1 decade of solo living, that is more than $70,000 that the single person spent and the married person invested. Mechanism 2, dual income and dual retirement contributions. Married couples can contribute to 2 retirement accounts simultaneously. They have 2 incomes buffering against job loss, 1 medical emergency, or a bad quarter in the stock market. That financial resilience is not emotional. It is structural. It changes how aggressively each partner can invest and how safely they can take career risks. Mechanism 3, home ownership qualification. In 2023, 61% of all home purchases in the United States were made by married couples. Only 10% were made by unmarried solo buyers. Married couples qualify for larger mortgages, get better interest rates because 2 incomes signal lower repayment risk, and are far more likely to accumulate a down payment together. Every year of delayed marriage is, for most Americans, another year of delayed home ownership. Mechanism 4, home equity and appreciation. Buyers who entered the housing market at age 30 have a 22.5% higher net worth by age 50 than those who buy in their mid to late 40s. That translates to roughly $119,000 more in net worth from timing alone. And since home prices have risen more than 80% since 2012, every decade of delayed entry is a decade of appreciation gains left on the table. Mechanism 5, compound investment growth. A person who begins investing $500 a month at age 24 instead of age 34 at a 7% average annual return arrives at retirement with approximately $1.5 million instead of roughly $700,000. That is an $800,000 difference from a single decade of delay. $1,000 invested at 25 becomes roughly $15,000 by 65. The same 1,000 invested at 35 becomes roughly 7,600, less than half. Mechanism 6, the marriage wage premium. Married men earn 5 to 20% more than comparably qualified single men. The mechanism is debated, but the premium is real and persistent across study after study. On a $70,000 salary, a 10% premium is $7,000 per year. Over 20 years, that is $140,000 before you account for compounding. Mechanism 7, compounding marital wealth per year. Jay Zagorski's landmark national longitudinal survey study tracked 9,055 participants for 15 years and found that married people's wealth grows approximately 16% per year of marriage. That is not a one-time jump. It is a compounding annual rate. And someone who marries at 23 instead of 33 gets 10 extra years of that 16% annual compounding running simultaneously with every other mechanism on this list. That is the stack. 7 things, all running at once. The 9 times net worth gap is not a mystery. It is arithmetic. Okay, those 7 mechanisms are interesting in theory. What they produce over time is more striking than the retirement numbers alone because the gap does not wait until 65 to open. It starts almost immediately. Take 2 people, Joseph and his college roommate Marcus. Both 25 years old, same income, same city. Joseph meets Jess. They marry at 26. They pool their savings and buy a modest home by 28. Marcus keeps dating, figures he will marry when he feels ready, stays in his apartment, pays his rent solo. By the time Joseph turns 30, he and Jess have 2 years of home equity appreciation and mortgage paydown, building a real asset they can borrow against, refinance, or sell. Marcus has a savings account and a lease renewal. The gap in this moment in absolute dollar terms is already meaningful. It is not enormous yet, but the directions are set. By 35, Joseph and Jess have 7 years of home equity, 7 years of dual retirement contributions, 7 years of shared fixed costs redirected into savings and investments. Zagorski's data shows married people's wealth growing 16% per year, year over year. Marcus is working hard, saving what he can, but he is running one engine where Joseph and Jess are running 7 simultaneously. By 45, the gap has compounded into something that individual behavior can no longer close. This is the research finding that most people miss. The gap is not driven by income differences between married and single people. It is driven by time and compounding. The Realtor.com 2026 Generational Wealth Report put the home purchase timing gap alone at $119,000 by age 50. That is before you add $800,000 more in retirement savings from a decade of additional compounding. Before you add the wage premium, before you add the singles tax savings. Check this out. Stably married Americans approaching retirement age carry average assets of $640,000. Americans who were divorced or never married carry average assets of $167,000. That is a nearly 4-to-1 gap at the end of a working life. And college-educated married people approaching retirement average close to $1 million. Their unmarried counterparts with the same education average roughly $425,000. That's crazy. The gap at the end of a working life is not a footnote in the data. It is the difference between retiring with options and retiring without them. So why does this matter so much right now? Why are we sitting in 2025 with married couples holding 9 times the wealth of single people the same age, a gap that has tripled since 2010? Because the cultural script that most Americans are following is running directly against this math. And the people who most need to know this information are the ones least likely to hear it. 91% of young adults say they believe financial independence is a prerequisite to marriage, that you should wait until you are financially stable, established, ready. It sounds like wisdom. It sounds responsible. But here is what the research actually says. For most people, the financial stability does not arrive before marriage. It arrives through it. The waiting is not accumulating readiness. The waiting is the cost. The Institute for Family Studies puts it this way: waiting for financial stability before marrying often means waiting for a stability that marriage itself would help create. You are waiting for something that depends on you not waiting. Yeah, and this matters because of who absorbs this belief most deeply. It tends to be working class Americans, people who know they are financially stretched, who are told they need to be established first, who believe they owe it to a future partner to arrive already financially capable. And so they wait. And the waiting means no joint savings, no shared home equity, no dual retirement contributions, no wage premium, no compounding. Every mechanism that would have been running sits idle. Meanwhile, the people at the top of the income distribution who absorbed the same message about financial readiness waited until their late 20s. But they waited while earning 2 professional salaries, living in cities with financial buffers, and then married into households that started with enormous resources. For them, the delay was relatively affordable. They entered the compounding engine later, but they entered it. The working class Americans who waited the longest, or stopped waiting and just stopped marrying entirely, lost access to the wealth multiplier entirely. A compound math problem had been dressed up as personal virtue, and the people who paid that tuition most dearly were the ones who could least afford it. All right, so does this mean the answer is just marry as young as possible? The research says no, and the data is specific about why. Divorce drops wealth by 77%. Zagorski measured this directly. When a marriage ends in divorce, every compounding advantage disappears in a single legal event. An unstable early marriage entered with the wrong person is the worst of both worlds. The compounding never had time to build, and the divorce erases what little was there. Here's what the divorce risk data looks like by age at marriage. Marrying under 20 years old carries a 38% divorce rate within 5 years. Marrying between 20 and 24 carries a 27% rate within 5 years. Marrying between 25 and 29 drops that rate to 14%. Marrying between 30 and 34 takes it down to 10%. So the risk falls sharply as you move through your 20s. The danger zone is clearly under 25, particularly under 21. Marrying before your life has taken any shape at all, before you know what you actually want, carries real financial risk through elevated divorce probability. But look at what happens after 30. The divorce risk does not continue dropping significantly. Going from 30 to 35 does not meaningfully reduce your chance of divorce. What it does do is cost you 5 more years of every mechanism on that list. 5 more years of singles tax paid alone. 5 more years of delayed homeownership. 5 more years of one retirement account growing where 2 could have been running. So the math produces a real answer. The optimal window is roughly the mid to late 20s, ages 25 to 30. Divorce risk has dropped sharply from the early 20s zone. You still have decades ahead for compound growth to operate. The median American man is now marrying at 30.8 years old, the median American woman at 28.4. Both of those numbers sit at or beyond the back edge of the optimal window. And the wealth gap in the data reflects exactly what the math predicts. The window is real, defined entirely by where low divorce risk and long compounding time intersect. And for the first time in recorded American history, the median citizen is marrying outside of it. This is not an argument for marrying the first person you meet at 26. The compound growth the research documents happens inside stable marriages. A bad marriage that ends in a legal battle at 31 wipes out whatever compounding had started, because divorce drops wealth by 77%. The math works in your favor only when the marriage holds. That's crazy, right? The difference between getting this decision right and getting it wrong financially is not small. You do not offset 10 years of forced savings with one bad divorce. So the guardrail in the research is honest and important. The financial case for marriage in your mid to late 20s only holds when the marriage is stable. And stability is not guaranteed by timing alone. What the research does tell you is that marrying in your mid to late 20s as opposed to your mid-teens or early 20s dramatically reduces your divorce risk while preserving most of the compounding time advantage. That combination, low divorce risk paired with substantial compounding runway, is what makes the 25 to 30 window special. You are not gambling on a marriage you entered too young without the resources or the self-knowledge to sustain it. You are entering with enough life experience to know what you want while leaving enough time for the compounding to matter. The financial case for marriage is not a case against caution. It is a case against unnecessary delay, and those are different things. Caution means choosing your partner well. Unnecessary delay means waiting past the point where the math works in your favor because the culture told you that waiting is always virtuous. All right. And the culture has a specific reason to say that, which we could spend another entire video unpacking. Universities earn tuition for every year of delayed marriage. Luxury consumer markets earn margin from single households who spend more on dining, travel, and personal services. Rental markets benefit from delayed home ownership. The financial incentive to keep you single longer is diffuse, pulling in multiple directions and very real. It does not require a conspiracy. It just requires that every institution with a financial interest in your singlehood also has a voice shaping what you believe about readiness. All right, married couples between 25 and 34 have 9 times the net worth of single people the same age. That gap has tripled in a single decade. It is driven by 7 stacking financial mechanisms: shared fixed costs, dual income, dual retirement contributions, home ownership qualification, home equity appreciation, the marriage wage premium, and compounding marital wealth at 16% per year. Every year of delay is a year those 7 mechanisms are not running for you. The compound math is not subtle. $1,000 invested at 25 is worth nearly $15,000 at 65. The same 1,000 at 35 is worth 7,600. Marriage works the same way. The earlier you start the engine, the more time the mechanisms have to run, and the optimal window, the place where divorce risk has dropped enough to make the marriage stable and time is still long enough to make the compounding matter, runs roughly from age 25 to 30. The median American is now marrying past that window. The wealth gap in the data is what you would predict from that timing shift. And the people most hurt are not wealthy professionals who delayed into high-earning dual income partnerships. The people most hurt are the ones who absorbed the wait until you are ready message and waited for a financial stability that marriage itself would have helped them build. Marriage was never just a romantic decision. For most people, it is the biggest financial decision they will ever make. and they are making it without knowing it is a financial decision at all. If this video showed you something you had not seen before, subscribe, because this is what we do here. We show you how money actually works, where it comes from, why it moves the way it does, and what the math looks like underneath decisions that everybody told you were personal. The history of money is everywhere, including in the timing of this.